Bringing right now, Democratic member of both the House Oversight and Armed Services Committee, Congressman Khanna of California. He represents the heart of Silicon Valley. So, of course, it's all Roe's fault and the fault of Roe's constituents. The crypto crisis, now Silicon Valley. No, you know what's so interesting about this? And I'm so glad you're here so you can provide insight. What's so fascinating is if this had been a regional bank, let's say in the Deep South, if this had been a regional bank in the Midwest, people would just say, oh, yokels, local yokels, they don't know how to run their business, blah, blah. This was in the heart of Silicon Valley, right? These were people that should have known better, and yet they've been exposed in the crypto crisis. Now they've been exposed, I guess we call this inflation crisis. What did these giants of tech industry, what did these bankers, what did they not see coming? What did they get so terribly wrong?
Joe, they made a couple of mistakes. First, the mistake was they didn't have a chief risk officer. They had these long bonds because they wanted the higher interest rates. And as Stephanie said, when the rapid rate hikes happened, those bonds lost value, and they had short-term deposits. They had 90% in tech. Tech started to pull out money, both because of the crypto crisis and because of higher interest rates, and they didn't diversify. But one of the problems is that they lobbied to weaken the Dodd-Frank restrictions. I voted against weakening it. They lobbied me and others to weaken them, to exempt them from the regulations that could have prevented this crisis.
Yeah, and Stephanie, I'd love to get your insight on this because there's been a debate raging over the past day or two about whose fault it was for this happening. And it seems to me that all these so-called libertarians who, of course, still want bailouts, they're saying, oh, no, it had nothing to do with the deregulation in 2018. It had nothing to do with the capital requirements for this bank. Nothing to do with that at all. Look elsewhere. I'm curious, where do you fall on this debate? And then we'll ask the congressman.
Okay, here's squarely where I fall. And while I totally appreciate the political debate of blaming Democrats or blaming Republicans, I blame Silicon Valley Bank and the executives who are paid millions of dollars to run the joint. And I'm sorry, they didn't have a chief risk officer at the time. Well, why the hell not? And where was the board? And where was the executive committee? There's absolutely no excuse for this. And where was Goldman Sachs, their very highly paid advisor, telling them to go out, sell securities at a loss, and then tell the market? Mistakes across the board. Now, politically, yes, because part of Dodd-Frank was rolled back, that meant small and regional banks could take more risk. But, Joe, that's a complicated one, because when Dodd-Frank was implemented, there's something called regulatory capture, where the big banks can afford as much regulation as you want to pile on them. But for smaller banks, they can't. And that squeezes them out of the market. And we don't want to be in a situation where we've only got 4 giant banks and nothing else. But the answer isn't regulate or don't regulate. It's smart regulation. And because Silicon Valley Bank and other banks pushed for so much of a rollback, then there weren't the necessary stress tests and capital requirements that could have potentially kept them out of this. And also remember, they went from being a small institution with $40 billion in assets pre-COVID to almost $200 billion. They were so jacked up to grow so big, and clearly they didn't know how to grow into their much bigger shoes.
So, Congressman, I know you spoke out in recent days saying the Treasury Department was not perhaps moving with enough urgency on this. Now we are a few days after the crisis. We heard from the president yesterday. How would you assess how the federal government has responded both before and after the collapse?
Well, I said these days bank runs happen at the speed of Twitter, and I don't think the government was quite there on Friday or Saturday. But by Sunday, they were there, and that's what mattered. They had to be there before the markets opened. And so I give them a lot of credit for coming out and saying the most important thing, that is that deposits are protected. In this country, depositors are protected. That's going to prevent a regional run, not just in Silicon Valley, but on regional banks, and they deserve credit for that.
Let's bring in right now the co-anchor of CNBC Squawk Box, Andrew Ross Sorkin, who's going to tell us exactly what happened and who we should blame. Andrew, what you got?
Well, I got to tell you, and I'm very curious what Congressman Khanna's got to say about this, because so many of the constituents of his who were venture capitalists, and Joe, you were just talking about it, who had their money on the line. I want to know what he thinks about the personal responsibility issue in all of this. And, we're talking about them, the sort of libertarian vocal strain, but this is a group of people who've been arguing for years with you, I think, about things like carried interest and special tax treatment for themselves, all on the basis that they're doing something that's privileged and special and different. And yet here we are, and we are rescuing them once again.
Well, here's what I would say. The people with the biggest money, the Andreessen Horowitz, the venture capitalists, they weren't at risk. And, Andrew, you know this. I mean, they're in sweep accounts. They're in money mutual market accounts.
Oh, you know what, though? I'm going to take issue with that. I'm going to disagree, because they might have been in sweep accounts, their actual bank, their actual funds. But the truth is their investments, all of their portfolio companies, the investments that they were making, which included pension fund money. But if those companies failed, they failed. There's no fees that they get to collect if those companies failed, right?
Sure. I mean, they, in that sense, that they had exposure, but that's saying, look, there were 50,000 of these companies at the bank, and some of those companies did things that employed people who were in the middle class. And so it also was about people's rent. It was about nonprofits. I mean, there was Silicon Valley Community Services Center that is a food bank with them. And so the question is the protection of depositors, which is what the decision was, in my view, is right. And by the way, we've done this before, not just for Silicon Valley. Jay Powell did it for the Bank of New England. We don't let depositors be hurt. This is not coming out of
But the reason I ask the question is, if we've become a nation of bailouts, and if we just recognize that's what we have become, 9/11, 2008, airlines and everybody in COVID, and now here we are all over again. Do we have to sort of rethink the system, including taxes? But maybe taxes should be considered just an insurance policy that people are forced to pay, because invariably we're going to need such insurance.
Andrew, we could debate the semantics, and I don't want to get into that, but I do want to say why this is different from 2008. In 2008, when the banks were bailed out, the money went to the bondholders, the money went to the shareholders. Here, what we're talking about is a deposit insurance fund, which has about $100 billion. It comes from fees that banks pay into it, and that's what's being used.
But the banks don't pay it. The customers pay it, because they pass on the cost of the insurance program to the customer.
Well, we could, sure,
that's
but
who
it's
ultimately
I just want to make sure that people know it's not going, because I do blame the Silicon Valley executives. I do blame the Silicon Valley board. I do blame the shareholders. I do think it's problematic that the Silicon Valley CEO sold $3.6 million. Now, it may have been a scheduled sale, so I'm not saying he did something wrong, but regardless, there should be a clawback. But none of those people are being protected here. Who's being protected are the depositors. And by the way, some of those companies, clean tech companies, climate tech companies, AI companies, defense tech companies, biotech companies. I mean, if you care about the IRA working, if you care about the Chips and Science Act working, if you care about the president's agenda to make sure we're ahead of China and bring manufacturing back, you've got to care about 50,000 of the innovation pipeline. And I guess my point is, yes, we need reform. Banks should pay a higher premium, and they should submit to higher regulation. And in turn, we should have higher FDIC for companies so that they can make payroll in this kind of crisis.
Can we go back to something, Congressman? How basically you're saying Andreessen Horowitz, listen, they're in sweep accounts. It's fine. Can you go back to responding to, but scores of small companies that they were invested in, which is the reason they make so much money, were not in those accounts. And some of the huge customers to Silicon Valley Bank were the ones saying to those startups, pull your money now, which caused that $40 billion to be pulled overnight. So it's kind of disingenuous to say, no, Andreessen Horowitz is in a different category. They're the daddy to all of those startups in there. That's how they make their money.
Sure, and that I'm not going to dispute that point, but the question is then what do? You've got 50,000 of these companies, some of them with venture backing, and they are not going to be able to make payroll. One of the companies, Rippling, is calling saying we've got 400,000 people on our payroll, many of them middle class, working class folks. We're not going to be able to make that payment. So what does the government do? Do we guarantee the deposits, or do we say, well, let these companies go under because they had venture-backed money? And I just don't think that would have been responsible, both because of the regional run on banks, which would have consolidated in 4 banks. And by the way, the 4 banks, J.P. Morgan, Citibank, Bank of America, and Wells Fargo, we do basically guarantee deposits. Does anyone think that we wouldn't support those deposits if that bank went under? Now, the deal is they submit to much higher regulation and meant more liquidity and stress tests, and I think that needs to be looked at for some of those regional banks.
So here we are again, Andrew. Again, you wrote the book on this, Too Big to Fail. But here we are again with this dilemma. And I've got to say, 15 years after 2008, after September 15th, I still don't have a good answer to it. I mean, we talk about Andreessen, Horowitz, we talk about, when there's not a run on the bank. I mean, these are the very people that we look to help finance the American dream, to help finance the great startup. And of course, when things go great, we salute and we go, yay, America. When things start to break that way, we go around looking for culprits. And so this is the dilemma we find ourselves in. Like this weekend, I want people to be punished if they make reckless investments in cryptocurrency or elsewhere. Right. At the same time, this weekend, I had a very different view than I did in 2008. I was against all of the bailouts in 2008. Of course, afterwards, you figured out the economy would have been wrecked. And yes, the U.S. government did end up actually making money on those bailouts at the end. But here this weekend, we go, wait a second. We have no choice but to bail these banks out, to bail these bad investments out. At the same time, we are now doing what you just said at the beginning. We are continuing to be a bailout culture. And my God, it sends such a horrific message to investors, to bankers, to everybody.
Look, I'm of the view, and this may sound completely unsatisfying, that you do have to pursue these bailouts. It's not a popular thing to say. I think it's the reality. It's the practical reality. But the problem of socializing losses and privatizing gains then becomes the conundrum. And then I think we have to start thinking a little bit again about the tax system. I know people don't like to talk about that, but here we are in a world where the rich get richer and the poor get poorer, and you got to be able to pay for all of this. And we have not come to grips with that. And I think that these kind of moments should be these wake-up calls where you should think that there could be bipartisan support. If there's bipartisan support for the bailouts, there should be bipartisan support for figuring out ways to pay for all of these insurance programs.
Yeah, and Steph, I want to get your insights on this as well, because you've talked about it before. We saw it during the COVID bailout, people that owned private jets figuring out a way to make money off of the COVID bailouts. You talked about that a lot. But let's follow up on what we just heard Andrew say. We've got a culture now that socializes losses, right, and privatizes gains. And the same people that are talking about, oh, the single mom should pull herself up by your bootstraps. Oh, we've got to cut back on this welfare culture, are the very people that say, come on, you got to socialize my losses here, or the entire economy goes up in smoke. I mean, come on. It is pretty maddening. And yet it seems like they've got us over the barrel because we can't let the economy collapse. We can't have all the regional banks collapse.
We absolutely can't have the regional banks collapse. We need the regional banks, but you also have to remember who the biggest lobbyists are, who's got the loudest voices. It's the people with the deepest pockets. So while we have become a culture of bailouts, not when it comes to student loan debt, where we've got people across this country straddled with tens of thousands of dollars that they have to cover. We ended the expanded child tax credit, which raised 40% of people in poverty, children in poverty, out of poverty, because that was simply too much for our government to spend. Yet when it comes to any sort of corporate bailouts, whether it's banks or airlines or industry du jour, we say, no, they employ tens of thousands of people. We have to help those companies. And what we don't do is help the individuals at the bottom. So to your point, and Andrew's, it's kind of like, hey, America, pick a lane and go with it. But choosing your winners and losers that's when we're in a truly morally hazardous place.
So, Congressman, there's going to be an open Senate seat in the state of California, and it's going to be a crowded competition. Three of your colleagues have already announced that they're jumping in, Representatives Schiff, Porter, and Lee. I know you are considering a run yourself. Can you give us an update on your thought process and how you assess this race? What would your lane be?
Well, I'll make a decision by the end of the month, but I am going to weigh very heavily Barbara Lee. She's been a hero of mine on the anti-war movement, and I think an African-American woman is needed. If I could say one thing to Stephanie's point, because I do think this is what's driving some of the anger in this country. I believe the Fed did the right thing to protect depositors and a lot of these companies. But when you look at Jackson, Mississippi, when you look at East Palestine, Ohio, when you look at folks with student debt and medical debt, they see that the Congress isn't capable of acting in 3 days the way they were capable to act here. And that is a big issue in this country. Why is it that some people who deserve relief get the relief and others don't?